Morning, everybody. I have with me today Henrik Zeberg, who is the head macroeconomist at the wealth manager Swissblock Technologies. And beyond that, Henrik is one of the most tremendous market analysts you'll find anywhere. I've done investing, securities analysis, my whole career. It's not often that I'm really blown away with someone's work, but when I came across Henrik in 2022, I have to say I was extremely impressed and have remained absolutely blown away by the work he's done since then. Henrik is actually an economist. He's a trained economic professional by background, came then to technical analysis and has this really unusual combination of being able to look at markets technically through pure price and volume analysis, but back that up with fundamental analysis, fundamental macro analysis. That's a really unusual combination to be able to do them both well. So I'm delighted to be able to talk to him today, and I wanted to ask him to expand a little bit on the shifting sands maybe between liquidity-driven market, which we've had since at least 2009, and when the business cycle starts to really matter, which in Henrik's opinion, that's the start to become more important going forward. So Henrik, thanks again for joining us today. Delighted to speak to you, and love to hear about your thoughts about things.
Thank you, Alex, and thank you for the nice words. That's special, and it always it's good when people appreciate what you do, and especially when you come in from the non-banking world, the non-financial world, and you start to do your own stuff, and then you just so thank you for that.
Sometimes it's a big advantage if you come at it completely cold.
Yeah, I think so too. I mean, I think there is a degree of maybe becoming too so fresh blood sometimes is good for society also to see, and I think that is what we see here with the financial world also. It's been kind of just leaning up against the same way of doing things, and actually I got to think of it. What would I have done if this was 30 years ago and I would have had to sit and do these things here with a pen and pencil or something like that? Sure. I mean, so I think also maybe things are changing because of the whole digital era, and we can start to analyze a lot of things, and we get it right in here on the laptops, and we can do
well, that's right. I mean, 20, 30 years ago, this sort of analysis was confined to the chart room of large banks and investment funds, and like everything with the internet, it's destroyed every guild that it's touched. Mm-hmm. And securities analysis is a great example of that, where if you're smart, if you're prepared to put the work in, you can become a terrific investor, a terrific trader and analyst without ever having set foot in a bank or a fund. And that's a complete change, even in the last 10 years.
Yeah, I completely agree. And I think that's why that the people from the outside that, just don't think so too much about how, you need to look at things or how it's been perceived, you need to perceive things or the Django. I mean, I don't speak the language of the financial people from that world either, but I don't care, because I don't think, I mean, it's not the necessarily the right way of doing things. And again, right. I believe enough in myself also, and I think other people should do the same in saying, well, if I can understand it, well, then probably there's something about it. And this is not more difficult than being an engineer or being anything else. So it's about sitting down, going deep into it, and just, I've always said, if you just put your mind into it, you can become good at everything. And I sincerely believe in that.
100% agree. I'm going to switch my camera off now and hand over to you. So maybe you could talk us through, Henrik, maybe liquidity impact first, and then maybe talk a bit about what you mean by the business cycle and why you think that's becoming of more importance at the moment.
Yeah, sure. And please, guide me along the way here if I just start to ramble. But I think it's an interesting perspective that you're putting forward here. This is about the liquidity perspective and the business cycle perspective. And if you go back in time, I don't think there's much doubt that there is something called business cycles, and you can actually you can watch it. You can just watch how the economy develops. There's a long-term trend line, and you can see how that is the long-term growth rate of the economy, and how the economy then shifts the cyclical behavior up and down above that or below that long-term trend line. And that is really the business cycle. So the business cycle is not everything you see, but you have to take out that long-term trend. And what happens in the long-term perspective is that if you look at it from a 100 years or even longer than that, you'll see that we are impacted by technologies at some point, and then that technology will help us spur growth, and you will see that the productivity levels of a bit of countries actually rises a lot, and we can see just with in the dot-com era. But also think back in the 1920s, when all of a sudden Ford came out with the manufacturing lines and all that, and you had the automobile and things like that. And there are different things to this. There's a reason why I talk about this when we talk about liquidity, because what happens is really that when the technology then are being put into use, first of all, there'll always be a lot of speculation around when new technology is coming out, and that's what we also see now with crypto, as I see it, and we've seen that before. But in the long time frame, you'll see also that the long-term growth rate is actually declining. And if you look at the long-term growth rate here right now, you'll see that it's actually been declining over the last 50 years, since the Bretton Woods coming out of the Second World War, and there was like a fresh restart of everything. And what then happens is that slowly there is a tendency, and that's actually something that's happened before, not just in this phase here, in this cycle here, where the central banks and the administrations, start to engage more and more in trying to stimulate the economy. And we, most famously, we have also when Nixon, took the dollar off the gold standard. And that is one thing that will, all of a sudden we don't need that kind of restriction any longer. Let's just make sure that liquidity can be flowing, and we can make it even easier for us to take on debt. And by the way, we will promise to support it by this and that and so on. That is actually part of this what we see. And then we have into the 90s, where we saw Clinton coming out and saying, hey, we need to make it affordable for everybody to actually own a house, and and that actually then pushed even more liquidity into the system. So, and then again we have Bernanke coming out and saying, oh, we need to make sure that we stabilize the economy, and we had this long period where we didn't have too much of the growth rate were great. So what happens in the long-term perspective is that even though that the real growth that we need in an economy is coming from real GDP growth, which is when you have productivity levels that are rising, and you need to have new innovation coming in, the society, everything starting to take that into the manufacturing processes and whatever, and then you'll see the productivity level rises, and the growth rate can actually also rise, and you need people also to get educated and start using that technology. That takes a while. But as I said, ever since the 50s, 60s here, we've seen the declining growth rate in the long-term perspective. And this is when at some point it begins to hurt, because that shows that gives us that the yearly growth rate is then actually not as high, because you can simply take a long-term growth rate as declining. That's because the yearly growth rates are not so good. And that means that you get closer and closer to the recession levels. And then you have the Fed and the likes and the academia that comes from the financial world thinking, oh, we'll sort that out. We'll make sure that we get from good Keynesian thinking. We'll just make sure that we get some extra production, and we do that by pushing out the LM curve in the Keynesian model, and make sure that we get the rates are just declining, and that can then more investments will then become attractive. People will spend a little more, and that is an ongoing process that has been going on for quite some time. And now I'm getting to it. Sorry, I'm rambling.
Yeah, no, it's quite right. And the thing that strikes me is, we are, this is an acute problem right now, but the long history of, monetary and fiscal stimulus rather than productivity growth, as you say, I think has contributed to the real perception now of a widening gap between rich and poor, asset owners and labor providers. All the same concepts that were talked about in the 19th century are kind of coming to a head, but certainly of more importance now than they were 10 or 15 years ago, because the more central stimulus comes along of whatever kind, the more spare money essentially ends up in the pockets of asset owners. And this is one of the reasons I think the securities markets, stock markets have ripped upwards so much since 2009, whereas wages have not. And so you're in a position now where if you own assets, you've had a fantastic run for the last 10, 15 years, just a tremendous run. But if you don't own assets, if you sell your labor for a living, it's just been dreadful, and it's getting worse.
Oh, but and that's the thing, and this is where I may say something here that can be a little controversial, but actually there is a thing to what Marx actually was saying. I'm not a Marxist or anything like that, but the thing what is happening here is actually that you are by stimulating the economy and by pushing this money, and we can see how much has actually been rotating into the financial markets. First of all, the financial markets then become, that's everything. If you're not there,
Right.
you
That's right.
you don't get it. But the people on the floor, the real, the real consumers that don't have as exposed to the financial markets, well, they will see that their homes are maybe rising in value and so on, but their debt levels are also rising. And that's
That's
why
right.
there is this schism also, where you see that the financial world becomes everything. And if you're just an ordinary Mr. Jensen, it's probably a little harder here. As long as the real economy can follow, but that's still where the real productivity growth is important. And if that does not follow, that's where the real wage growth, the growth also cannot follow. And I think that is the problem. That is where we right now we're living in a world where ever since 2008, we're just, wait, let's just print some money, because
That's
we
right.
have seen this now for 17 years, and every time we do that, we have a like boost in the stock market, and everybody's saying, oh, this is a new economy. This is, Bernanke. We gave him the Nobel Prize in economics because he invented modern monetary theory. I mean, I have to
Yeah.
say it as many times as I can on these interviews, because I think it is ridiculous. I have to say, I lost a lot of respect for the committee there, from going out and simply not understanding that what we're doing is, there's nothing new under the sun here. This is the same thing. We're pushing down rates. We are making investments more, poor investments look better, because the yields that I can get elsewhere is just lower.
That's right.
Hence, it's easier for us to finance investment, and you can keep doing that. And actually, we are at the point, especially in a place like Japan, as I see it, where Keynes was famously asked, but what are you going to do theoretically at the point where you have stimulated the shit out of everything, and you have yields and interest rates at zero? What are you going to do then? And then he said
That's right.
famously, in the long run, we all dead. And he
This is
avoided
fantastic.
but he avoided that question, where Mises, he
Yeah.
actually says, well, if you keep doing that, you are either going to bring down that bubble yourself, or the financial system will eventually collapse. And if that's the course we're on, well, it can take a while, but I think we're getting closer to it in certain countries, where we actually see that um, valuation of uh, things that has zero value. I mean, meme coins at this point. It also dislocate capital, because at some point, people become desperate. I got this million in my bank account. What should I do with it? I mean,
That's right.
where should I go? And some people that are more into the business world, they'll run to a PE fund and they say, hey, dear Mr. Partner of a PE fund, you're so clever. Go find me a business that will earn me 5, 6, 7, 8, 10% a year. And the PE funds, they'll go out and they try to do whatever they can in an environment where you already have crazy valuations. So this is something that is feeding, and you can keep pushing it for some time, but eventually things unfortunately will not just be, because inflation will be the outcome of it at some point. I'm not saying it's right here right now, because I still think that has to do with the business cycle. So
Yeah.
long story, that's liquidity. That's why we have this situation with liquidity here. And I am the reason why I think this time is different with liquidity is because we actually now saw what I think was the inverse Volcker moment in 2020. That was instead of doing what Volcker did in 1981, where he raised rates and we had the recession, and he famously was called to have brought broken the neck of inflation. I don't think necessarily it was him doing that, but that's for another day. But you actually see then, ever since, you've seen inflation moving lower. I think we got to the inverse of that in 2020. That was the shift, and that's why we are now in an inflationary period. People don't know that, but we see the short term. But in the long time frame here, I think inflation can be going up a lot, and that does not mean. And again, this is about timing, because we know the markets goes up and down. I think short term, medium term, we can actually see that the rates yields will come down quite strongly, because the business cycles are rolling over. But I think that the change here is that the free lunch that we have had for such a long time, where we came to the ultimate, let's just print the money and send it out there. And that is bringing out the animal spirit to a degree, where things are now just so valued to the extreme. And as I put up a tweet the other day here, we see we have the market capitalization to GDP without crypto at
Yeah. I
213% at
saw
this
that.
moment,
Yeah. Yeah.
and 226 if we look with crypto, which why wouldn't we bring that under
Yeah.
as part of it? that's insane. I mean, even if markets went down 50% today, 50%, we would still be higher than we were in 2007, which was a very high level, and we'd be. So I think that's liquidity has been bringing this bubble that nobody understands that we're living in. And when people say, yeah, but Henrik, why should it come down at some point? Because there's a shift. First of all, in the inflation, the inflationary regime has shifted, and secondly, also because it's the simply the what do you call that, the split between the financial world and the real economy,
Yeah.
and I think that is really being, as you also mentioned before.
Yeah. So I think that the challenge for investors, whether one is a long-term investor or a trader, is trends can carry on, trends up and trends down, or even sideways trend. It can carry on longer than anyone thinks, and it's really easy, I think, for anyone to analyze their way to conclude that a particular trend, be that up or down, is about to change, and you can cost yourself money, meaning either actual losses or just surrendered gains, missed gains, but by over analyzing things and not going with the flow. One of the things that I really love about your work is, I found you in 2022. I found you because in our own work at Cestrian, we'd sort of got ourselves convinced that the 2022 bear market was not, the final collapse of capitalism, as everybody was saying at the time, but a correction, and one that would end. And I could find really nobody that agreed with that. And when that happens, you always worry about whether your own analysis is completely off beam or just a bit early. And our call for that was a bit early by a couple of months, I would say. But I
Same
loved it
here.
when I found
I
your
had to say,
work,
same here.
and yeah, but I mean, but you were one of the only voices saying, "Look, calm down. You have a great Al Pacino tweet you always put out. Calm down, right? Take it easy, relax. Which is this is a correction. This will end. This will bottom out." And I remember you saying loud and clear, when this bottoms out, it's going to rip. There is going to be a huge bull run that follows this, and of course that has happened. And I don't think you get enough credit for that, because people forget how bearish everybody was in 2022.
Exactly.
So
I
when
thank you
I
for
hear,
remembering.
no, I mean, I thought
Yeah.
it was a fantastic
You
call.
were there yourself also. You were looking
Yeah,
for similar minded people. Yeah, I got that.
yeah, I couldn't find any. So when I found yours, I was like, okay, that's two of us. So there probably are some others.
Mm.
Um,
Yeah.
and at the time, I remember saying to all our subscribers, you've got to follow this guy. This guy's work's terrific. And the thing that's really impressed me since then is, it's easy, I think, to be perma anything, perma bullish, perma bearish. A perma bull will see a correction and say, "Oh, I wish there's a correction, it's going to rip," and they will miss a real bear market, a real 2007,
Correct.
2008, dump.
Yeah.
A
Yeah.
perma bear, every time the market drops 2%, will celebrate and rejoice and say, "Ah, I told you the world was ruined. There you go, there's evidence." And
Yeah.
these are terrible methods, and these
Yeah.
methods dominate, particularly social media, because they're
Yeah.
prone to, hyperbole. They play well on YouTube, but they're misleading as to how the world works. And what I really like about your work at the moment is you've been saying, look, this remains a bull market, still a bull market for assets. Asset prices, I think I'm quoting you here, are going to still run up, but you've got to keep your eyes open, because this reality stuff that sits beneath this flood of liquidity, that will rear its head, and when it does, that will signal a turn. And I haven't, heard you say like the world's ending. It's just a,
No.
bear markets follow bull markets as sure as
Right.
night follows day, and
Yeah.
as everyone else right now is becoming, frankly, euphoric. I wouldn't say we're at a peak today, but we're heading that way because so many people are now bullish. It really interests me that you're sort of starting to say, okay, but start to be careful now.
Yeah. No, I do that because I first of all, I'm arrogant enough maybe, or stupid enough, I don't know, to put up an idea of where I think things can be going, because then it's like putting up a thesis. This is doing any kind of research. You will always put up a thesis, and then you'll test it and you'll test it and you'll test it, and you'll find out whether you try to invalidate the thesis, and at some point it actually starts to work out. So what I do is that I'm trying to put up theses for what I see, but that thesis has to be in line with everything. So this is where the multidimensional approach of my methodologies comes in, is where I simply say, well, if you're going to see uh, a crash at some point in the top, well, then you need to see the dollar actually also starting to rally, because you'll see that there
Right.
are, if you get a recession, you're going to see that's going to happen. And then you're going to see this, and that, and so on. I mean, so I'm calibrating it with everything that I see from the markets. This is then where I use the Elliott wave. I don't do that on a very short time frame, because I don't think it's you can use it for that for 4 hours charts, and not something you can do, but not in terms of predicting longer term perspectives. And that's where I simply have this multidimensional model in terms of the dollar, commodities, anything, you name it, bonds, and so on. And that then, with these kind of input, helps me say, well, this is probably what is going to happen, but I have to align it in all of those. I simply can't go to bed at night and say, hey, now I just changed my view on the S&P, because then I think, whoa, because is that actually calibrated with everything else? So when I'm changing things, it's a big thing. Then it's because I say, okay, now I see a shift in certain things, but that means that other things have to fall in line with that.
So one of the things you said recently was, everyone is so bearish the dollar because apparently it's all over
yeah,
for America and just they're going to lose the
yeah,
reserve currency status. And
yeah,
and
yeah.
you were saying some weeks ago, nah, it's in a bottoming formation, it's going to pick up, and of course that
Yeah.
has started to happen just now.
I
And
don't think I don't think this is it though, but I think there's one more leg to it. But that's where the structural understanding of things also, because again, if
yeah,
I said it was here, then I would find it difficult to see that how crypto market could actually keep developing. And I see the structures there are simply not done. I don't see it for a lot of currencies that I also follow: the dollar, Swiss franc, the dollar, euro, and so on, euro dollar, and so on and so forth. So everything needs to fall in line. That's why I'm saying I think we're seeing the beginning of this next coming bull market in the dollar, and it's going to be ripping. What we've
yeah.
seen now is actually the counter move ever since the September 22, when we had the first decline. Then you went sideways for longer than I expected also, but it went sideways, and then it came down in this decline here. Everybody in January were so bullish the dollar, and I said, oh, it's going to come down, it's going to come down as
I
fast as
remember
we
that.
saw.
I remember. Yeah,
Yeah, and
I
now
remember.
we're
I
getting
think the
closer
other
to
thing
that bottom. Mhm.
yeah, I agree. And I think one thing that's misunderstood about this is the impact of the Genius Act and the
Mm,
legitimization of stable coins. We're going to see
mm,
more and more stable coins issued, and more of
mm,
them are going to have more collateral. And that collateral is going to come in the form of dollars or US
mm,
treasuries. And I'm
mm,
not sure the penny has dropped really, which is crypto and fiat just got a lot closer together. The more stable
mm.
coins, the more
Yeah.
demand for dollar denominated collateral. And I think it's one of the things that will bring the yield down is that dollar demand and treasury demand, and it's going to be stimulated by more stable coins being used for grown-up tokenization purposes, not just speculative crypto
Mm,
gambling, if you like, but the use of Ether and Ethereum in particular for
mm,
grown-up asset manager tasks.
mm.
And I think there's a whole new category of demand for the dollar and for treasuries, which I think people have not quite realised that these things are going to move in lockstep for a little while. And I know
No, I
your
agree. I agree.
crypto coverage is great, so you've seen this
Yeah,
already.
but I think you're spot on with that as well. I mean, there are reasons why we could see some of these developments, and of course all the things we see now with crypto and with yeah stablecoins and the likes is going to impact this as well. But I also think it will also simply be, and that's back to the business cycle, that you're simply going to see that the business cycle driven by the consumer. It's really about the consumer all the time when it comes to the business cycle. It's about where is the consumer going? Is the consumer happy spending money, or is the consumer holding back? And the business cycle driven by mainly two markets there. It's the labor market and it's the housing market. And if these two are doing well, then you'll often see that then the business cycle is doing quite good. But often you'll see that when rates are going up high, yields are moving higher, then you'll see that it's actually the housing market that starts to take a beating first, because we have to finance something.
That's
And I think we're now seeing that slowdown in the housing market that has been actually lasted for quite some time. If you see the number of existing homes sold, it's at levels where when the U.S. Population were 60, 70 million people fewer, we are at those levels right now. That means homes are not being sold there. And that is okay for as long as people are not losing their job. But if they start to lose their job because we have a slowdown, if if we don't get that pickup in growth that everybody expecting, and in demand, well, then you have something else. And that is probably the slowdown that I'm thinking that is going to bring the dollar to rise, because the problem is the debt of the world is 60-70% in US dollars, and there
Right.
will be a demand for that. But I get your point on that,
Right.
Zeberg, 100%.
So if I'm an investor today and I don't want to miss out on the bull market, I don't want to step out yet because I think it's still going up, but I want to calibrate my radar, get my antenna up. In your opinion, what are the 2 or 3 things that I should be looking for that should tell me when trouble might start to hit? No one can do this perfectly, but in your opinion, the 2 or 3 things that I should watch to go, okay, now I need to really, be on my guard for a turn in the market. What would you do?
First of all, I will not look to the media. First of all, I will shut down everything there,
Yeah,
and because it,
that's
and so
that's a
no,
very
but
good that's a very
honestly,
good point.
I mean, and pretty much do the opposite. But in a more, I would look to the main drivers of things. I would look to first of all, I would say, well, things are not great when you see that the housing market is not doing great. We can see that. We can just look at that historical perspective and see that when the housing market has been stagnating, it's not been good times, and that's what we see right now. So first of all, get to the understanding that even though stock market is running up high and cryptos and so on, that is not the same as things are great, and take away this notion also that people are the understanding that if the stock market is doing great, that is because things are great. I mean, we had the great bubble into 2000, and it was not because things were great. So we need to go past that. So, and understand that the main driver of big market crashes is when the housing market is stagnating. That we see right now. Put that aside as a kind of a background, or into the backbone here on this, and say this is the environment we're in. The economy is not as great as everybody thinks. Then look to the labor market and say that's the second part, the second most important market. Which, as long as people are not getting laid off, it's not such a problem, because then they can still pay their mortgages and things like that. They'll make ends meet. But you got to look at when that we start to see that deterioration there, and that deterioration is actually already happening. But just
Hmm.
we just get the non-farm payrolls numbers every week, and every month, and we see, well, they are within expectations, or 5,000 higher or 10,000 higher, and that's okay, great. First of all, they are very often adjusted by up to 50,000 per month, going a year
Yeah,
back, when they do
that's
the
right.
revisions.
That's right.
That's one thing. So you cannot just lean up against those, and we have another number coming here on Friday. Secondly, then you go to look at, if you look at the weeks of unemployment, so average unemployment for people, and then seeing that has actually also been moving up. That is also just a structural thing, telling us that if you go back before 2009, people were actually on average unemployed for shorter time than they are today. So the labor, much shorter actually. You should take a look at it. It's actually very, very clear. And there's some sort of shift that has come in there in terms of the average time being of unemployment, and that is a structural problem with the labor market. So
Yeah.
there are things that needs to be looked upon in the. I know what you're getting to, what is the triggers that we need to look at, but I just want to say that there are things in the labor market that can always be watched, and see that things are not great. The continuing jobless claims are also staying high, and actually been putting in a very nice rounding bottom, and seems like they want to move higher. So looking at that and then saying, well, we have the housing market, we have that structural thing on the labor market, and we have the massive bubble of the world. What should I be watching? The three things I would say is, first of all, look at the short-term yields. The short-term yields is one of the things that when they start to plummet, you will see that's because the expectation is that things are going to be to go into something bad, and that's normally the 1 month yield, U.S. Government bond yield, the 1 year, the 2 year also, and I actually have some tools which will tell me that when it crosses a certain, let's say, a panic point,
Hmm.
that's when the shit hits the fan. That's why I want to say. I said on Twitter, let me try to see if I can point out the month that the recession actually starts this time,
Yeah.
because we know the NBER, they will come out a year later and say, oh, by the way, recession
Yeah.
started in
That's when.
December
Well,
of
it turns out
2000.
we're in recession. That's right.
We had a recession, yeah, but you can actually look to those, and that's why the yield levels, the short-term yields are one thing, and obviously also then the yield spreads, but also
Yep.
looking at the labor market, just simply looking at the initial claims and saying, hey, we are at historically low levels right now, but if you start to see something of a move up there, and there are certain levels, and well, then maybe those structural things that I was mentioning in the other part there is starting to develop. And that's what I do with it. That's actually the leading and the coincident indicators. So you have the yield spread and so on has been part of and the housing market has been part of the leading indicators telling us things are not great. It's not here, it's not right now, but they're not great. So please look at your coincident indicators and tell us how that looks. And then that's where you then look into those and say, when do we start to see things developing? And I look to momentum of things. And this, I was actually in a chat at one point with one of the guys from the industry, right? And it was a capital fund, and I tried to explain to him how I do things, and I was like almost made fun of that. You use momentum analysis for
Oh no,
macro indicators.
okay. But if you're being made fun of, that's when you know you're onto something, right? You've hit the
Exactly,
nerve.
and that
When anyone's
yeah,
laughing
you
at
hit it.
your work, then your
Yeah, but
confidence should go right up.
I'm okay with that, and I could see that that what they made in terms of return was 7% when the Nasdaq was up 22%. So I thought, okay, maybe they missed something. But anyway, but so I looked at it and I said, well, but the economy is a super tanker. You have to understand when there is a certain move in a certain direction. That's also why the Fed can't turn it on a dime when they come in and do. So we have to look to the momentum also of these things of the macro, and I think that is one of the things I also do. So when the shit hits the fan, which it hasn't done just yet, means that we're not in an imminent threat of a recession, meaning the next month or this month. Then but there will be signs of that, and those are within those
Great.
areas that I mentioned there.
So
They are there.
I would
They are there. You can look at it.
That's great. So I would say to anyone
Sure.
watching this that doesn't know Henrik, you absolutely should follow him on Twitter. We'll post his Twitter handle under the video right here in comments. But if you just search him on Twitter, Henrik Zeberg, a huge following. And if you don't follow him, you really should. His work's tremendous. He also has a series of paid newsletters that you might want to take a look at. That depend on your circumstance. But do follow him on Twitter. He's really tremendous work. And again, I've been in this business for my whole career. It's not often that I really come across someone that I'm super impressed with, but I think Henrik does just a great job. And for the 3 years I followed him, just continue to be impressed. So do take a look at his work. Henrik, thanks so much for spending time with us today. Really enjoyed talking to you as always. And I know that you continue to put great stuff out there for people to read. And again, do take a look at Henrik's work. I encourage everyone to follow. Thanks a lot, Henrik. Talk to you soon.
Thank you, Alex.